Credit Talks on Facebook. My name's Liz, and back by popular demand is Carlos joining us. How are you today?
Hi everybody, how's it going? I'm doing pretty good.
Make sure you use the hashtag BoostCredit on any of our social media platforms if you have any questions for us throughout the segment, or you can drop it down below in the comments and we'll be sure to answer it, if not in the live series, because I'm sure a bunch of you right now are on the internet trying to buy those Coachella tickets. So if you catch it later, we'll still be able to answer those questions in the comments below. So today our topic is on loans and interest rates and this idea about millennials and are we really doomed to live at home forever? So I did some research and I looked actually with a couple websites, and it says, according to the National Association of Realtors, 50% of first-time homebuyers said that their student loans delayed their savings for a down payment, and I can vouch for that. I mean, student loans definitely take a toll on your financial future, because not only do you have that burden from trying to get an education, but sometimes those payments can last you all the way into your 30s and 40s, when you would hope to save that money for maybe a home down payment like maybe the baby boomers got to do. And another economist from Zillow said that first-time home buyers are getting older. So I think that's pretty average. I think there used to be kind of frowned upon to be living at home in your 30s, but now it's more and more common because people have a fear of renting versus buying, and we're going to get into that a little bit later. And the average age has moved up to 31 to 34, where maybe it was around the 20s you were expected to own a home and start that future. And the Wall Street Journal found that the share of first-time homebuyers in the market fell from 50% to 33% in the year 2014. So the great thing about millennials is that we still do value getting a home, and I think that there's a huge misconception that we want to live at home with our parents forever. No, I think that's a very misconstrued and just a kind of generalization about millennials in total. So what they found is that this is a study done in 2015 by Credit Karma. What they found is that we still desire and value owning a home. In fact, 83% of millennials defined it as financial success. So owning a home defined you being financially successful. And 92% still believe that they're going to buy a home. But what they did notice is that there is a lack of education within millennials. And a lot of that has to do with not knowing the credit score that they need to even qualify to get a mortgage. So for Sallie Mae, the mortgage company, you need a minimum FICO score of 640. 50% of that group that ordered it, that Credit Karma pulled from, had a credit score greater than 640, but only 14% were actually sure of that when they applied. You want to talk about some regional differences?
So, regional differences. This was a very interesting slide that Liz was able to pull together. And you can see right here that depending on where you live in the country, where you're geographically located, the differences between what the average home cost is can vary wildly. For example, if you look over in the Northeast, the average home price in the Northeast is almost $200,000. But you've got, within that very region, you've got a low in Dunkirk, New York of $60,000, which is amazing. If you're here in California, you know that for $60,000 you cannot get anything at all. They might sell you a postage stamp-sized piece of land that you can put a tiny house on. But in Greenwich, Connecticut, it's going to cost you over $650,000 for a home. Very similar here in California. In Los Angeles, being as large a metropolitan area as it is, you know that it goes from a high of almost $1 million on average in Beverly Hills to other areas that are maybe more outside or farther closer to like the county lines, where you can, get a pretty reasonable house for $350,000. So it really is all about location, location, location. And that said, depending on where you live, depending on how much you're earning, depending on what's going on in your life, you're going to have to plan accordingly.
And even, again, back to that study in 2015 that Credit Karma did, where we pulled this study from, is they found out, so what they did is, out of the 500 millennials that they surveyed, they looked at the credit score, and only 6% of millennials that live in New York and Washington, D.C. have a mortgage on their credit profile, whereas 17% is from Utah and Wyoming. So that's a huge difference. So where you live in the country, just like Carlos says, to reemphasize, is going to make a huge difference. You're going to just need to tap that, Cynthia, sorry. Tap the trackpad, and that should, perfect. Next, we're going to kind of get into the impact of interest rates. And this is super important. We've had this talk in the past about how important it really is for interest rates. I'm going to talk a little bit about the math behind it, and Carlos is going to go ahead and shoot here. So one important thing is interest rates, and we kind of have to take it back to, again, 7th grade algebra, where we learned this very important formula. Interest is equal to our principal, our rate, times our time. Now, the important thing about multiplication, for all of us to kind of sit back to that awkward time where we probably weren't very confident in ourselves, back to our 7th grade math class, when we multiply products together, what we're going to see is one product gets bigger, our multiplication is going to, our product is going to get larger and larger. So if our principal's big, if our rate is big, or how long we have that interest is big, our total net interest is going to become larger and larger. So that's it. Do you want to talk about?
Well, and that's very important what she's talking about there, because like she said in the portion of the slide that I need to talk about, total cost of an item, right, equals principal plus interest. So if you're talking about a car, it's how much the car is actually costing plus how much it's costing you to borrow the money. But the other thing that's important is time. So for example, you might be looking at a loan for a car, and they'll give you an option between 36 months and 48 months. That is a huge difference, because the more time that it takes you to pay something off, the more it's going to cost you in interest, period. Even if, you can find, it's never going to work out that it's going to be essentially the same rate, just at a different time level. It's always going to cost you more the more time it is. So you have to keep that in mind. Principal plus interest. An interesting story when you're looking at your mortgage, when you're looking at refinancing or financing for the first time. One of the things that you have to keep in mind is that what you're really paying for your house over the entire life is going to be that compounded number. So you might be borrowing, in California, for example, you might be borrowing $300,000 for a house, maybe $400,000 for a house. But in the end, you're on the hook for $500,000, maybe even, $750,000. It doesn't seem to hurt you at the time because you're going through it a little bit at a time, but over the life of the loan, those kinds of huge numbers definitely can give you a bit of sticker shock.
And you'll see that in a slide up and coming. So what we have here is, we just really want to emphasize, and I think this is one of the main points that we drive home in every Boost Credit talk that we have, is the importance of good credit. And that is because credit is really going to tell, it's going to be your evaluation of risk to that creditor. They're going to see how willing are they to lend you that money. It's going to determine the cost of products, and it can determine you being able to pay less in interest. So having a good credit score makes a huge difference in getting loans for interest rates, and it means exponential difference in savings, like you're going to see in our example up ahead. So we have our very infamous Demetrio, which everybody loves, and Kayleen, which you guys have yet to meet. So Demetrio has had some financial difficulty in the past, and as a fact, he has a low credit score of 620. He can barely qualify for a mortgage, and when he does, he ended up getting an interest rate of 4.6%, whereas Kayleen, she's a rent reporter, she pays her bills on time, and she has a credit score of 780. So that higher credit score gave her an interest rate of 3.1%, and you're going to see, look at how close these interest rates are together. They may not look like a huge difference, but you'll see. Let me go ahead and...
So here we've got, again, the mortgage example. You have a home amount. The home loan amount is the exact same. That's the principal, right? So $400,000 on either side. Loan amount is $320,000 because they have to put a down payment, obviously. Over 30 years, 360 payments. And so you put it through your handy-dandy formula, I equals PRT, and what you end up with is total interest over on this side of $270,000, total interest on that side of $170,000. Grand total of the loan is $100,000 difference between the two. That is remarkable, because what you could do with $100,000 if you had it, right?
And like you said, that's just a 1.5% difference. And the next thing that we want to get into is the impact of the economy. So we're going to look at two periods that we talk about, and that's the expansionary period and the contractionary period. So in an expansionary period, it's just like what it sounds like, the economy expanding and growing. So the economy is growing rapidly, employment is high, as well as consumption. And as a result of that happening and that stimulation to our economy, the Federal Reserve will raise interest rates to keep up prices and to prevent inflation. So what we'll see is the economic results is that banks are going to be willing to pay more interest in their deposit accounts. This means that interest rates are going to be higher and the prices of loans is going to be greater. So it's going to be a lot harder for those to get them, and when they are able to qualify for that loan, it's going to cost a lot more money.
Now, if you don't mind, Liz, before we move on from that slide, real quickly, literally just before we went on today with this presentation, we were talking about this, because these fluctuations, they don't just happen over a long period of time. They literally can happen from day to day. So it is possible that depending on what's going on in the world, you might see a difference in an interest rate from day 1 to day 2, literally just based on what's going on in the world. So it's definitely a good idea when you're thinking of borrowing money, whether you're thinking of borrowing money for a car or a personal loan or even a house, keep your ear pressed to the ground. Start following current events, because you never know. If you know that something is going in a particular direction, you might be able to shave off, a tenth of a point or a couple tenths of a point or even more, quarter of a point even.
And next would be its opposite, which is the contractionary period. And what this is the economy is contracting, so it's getting tighter. And so it's going to plunge. Unemployment rates are going to tick up, and the stock market tends to trend downward. And so as a result, it's going to be the complete opposite effect of what we've seen in the expansionary period. Interest rates are going to lower in attempts to stimulate the economy. So now we're trying to get people to buy into our economy. So the effect is going to be a decrease in these interest rates. Banks are going to be more willing to pay less in interest on their deposit accounts, but it also means that the cost of borrowing is going to be a lot less. So this might be the ideal time to pull out that loan or take out that mortgage for whatever we need. And this is kind of a review slide.
Yeah, so very quickly, what she had said, to review, in an expansionary period, things are growing, money is becoming less and less plentiful. We're trying to combat inflation. We're trying to make sure that things are under control and not getting, running away, basically. In a contractionary period, it's the opposite, trying to promote growth, trying to make money more easily available, trying to make it so that people are able to borrow, businesses are able to borrow at lower interest rates, and then do something with that money that hopefully, promotes growth, promotes more activity in the economic system, and that's basically it.
And really quickly, we're going to, for a short period of time, talk about what we can do as rent reporters. Remember, we're not really just trying to sell our product to you. We really want to educate you on how, if you are a renter right now, how much this service can impact your life, or just in general, boosting your credit is really going to help your financial success. So what's great about rent reporters is what we actually impact on your credit score. So we hit three main things, which is your payment history, your age of credit, and the type of credit. Do you want to kind of hit each one of them and how we affect it?
Yes. So payment history, for example, when you sign up with Rent Reporters, we can report up to 24 months of on-time rental payments. So if you've been renting the place that you're currently living for at least 24 months, you will get the full benefit of our initial report, which is great because that is going to show a real increase in your credit worthiness. They're able to see, look, 24 months of on-time payments, and that leads us to the next side, which is age of credit. Let's say you've been living at the same place for 6 years. Not only do we report that the 24 months of on-time payments, which is what we were able to do, but we're also able to report that you've had that account, that open account, for a full 6 years. So that's 6 years of age of history. Let's say, for example, that you've got 3 credit cards and that your overall age of credit is 2 years total between everything. Your average, 2 years. When we jump onto your credit report, that automatically boosts your average age of credit significantly. Type of credit. You might have 3 credit cards and that's all you have. Or you might have 3 credit cards and a student loan. With us, you get a trade line that is different than either of those. And that trade line then in turn might allow you to get, well, first of all, you get a higher score, and that higher score will then allow you to have a platform from which to jump to a better credit card, or, from a better credit card to a car loan, and from a car loan maybe to a home loan. And so there's a lot of these different things that you can do. Our product is definitely part of a balanced breakfast. If you're signing up with us, like a lot of people are, they're definitely interested in trying to get their financial future, their financial house in order. And we're like the cornflakes of that. So you just have to get in there and start doing all of these things, but we're definitely something that can help catapult you to the next step.
And I think we kind of hit everything, and that last slide, this is just more to reiterate that point, but I think one thing that Carlos said that I really enjoyed is that part of that balanced breakfast. And please go back and watch some of our other Facebook Lives that we've done, or we're going to continue to talk about other ways to continue to grow your credit, because yes, this is one thing that you can do, but remember, there's things like paying your bills on time. There's all these factors that you can do to help boost your credit score. So the next thing we want to get into is this idea of buying versus renting. There's a huge debate, and people are not really sure what's best for them. And I think that's a big decision, and I think a lot of the time it can be construed where a lot of which they buy a house. Like, it's a no-brainer. You should just buy a house. Owning property is better than not owning property. And then there's been the opposite effect where you'll see in a lot of articles recently where they're saying, actually, buying's not smart at all. In fact, what we're going to try to drive home for you today is it depends on your situation. And we found this really cool article from the New York Times. Why don't we go ahead, Cynthia, and click on the image, and it's going to take us to the New York Times, where there's a really cool interactive article that's going to give you what's best for you. So it's very individualized on telling you, is it better to rent or buy? And Carlos has actually used this in the past, so he's going to go ahead and really explain it to you guys.
Yeah, now it's really funny because I actually found this and used it after I had bought a house. So I kind of just used it to check my math. That's really not the best way to use it. Use it ahead of time. Get prepared. Be prepared. So if you look here, it lets you set your home price. It lets you set how long you plan to stay in the area. Obviously, you don't have a lot of control over that, but in our case, we were able to set the home price to the home price of the house that we ended up buying. And then how long we planned to stay. Well, part of the reason why we bought is because we love LA for starters, and we want to live here forever. And so we bought a house so that we could make that happen. And so basically, if that's your setup, it automatically is going to tell you, yeah, you probably should buy something. But it also has a lot of other details, like, well, what's your probable interest rate going to be like? What's your down payment? How much money do you have to do this with? What is the length of mortgage that you're looking for? What does the future hold? It'll ask you, it'll ask you a bunch of different questions here, all trying to kind of figure out, should you do this or shouldn't you? And in the end, it really ends up being a very personal decision. But this right here can at least get to the point where you are able to assemble the facts, assemble the data, and make an informed decision instead of just jumping out completely. In the end, emotion might have a lot to say with what you end up doing, but at least you will come, well prepared and forearmed to be able to do the right thing for your future.
And make a decision. And you'll see one of my favorite things is, yes, you can calculate all of that information with as much as you know, but the important thing that it tells you up here in this, right in your right-hand corner, is it tells you at what price is it going to be better for you to rent versus to own. And that's really important, because besides the debate of whether renting versus buying is best for you, because people are on opposite ends of the spectrum. If you buy, you own your home, but if you rent, you're not going to have to worry about repairs. There's all these factors that are going to be so individualized to you. So that's the main point that we want to talk about, is whether buying versus renting is best. Okay, let's go back to the PowerPoint, over to our tab over here, right here.
Oh, sorry.
We're good. And then click the screen. And then we'll go back to present mode up in this corner.
Where, Liz?
Right here. There we go. Perfect. So this is a really, really neat article. If you're in that market, please check it out. A lot of our customers, sorry, Carlos, a lot of our customers are in this market. That's why they use our service. That's not the only customers that we cater to, but we do have a lot who are kind of right at that edge of wanting to buy a home, and they kind of just need to boost their credit a little bit, and they need to make a decision. So this is a great resource to use.
And again, big props to the New York Times and to the writers and editors that put it together, because like I said, this is an amazing tool. When I found out that we were going to talk about it here today, I was just pleased as punch, because this is great.
Really awesome. And then we just kind of want to go back and reiterate some of our main points that we talked about, and that's the importance of credit, one, and that is that a good credit score is going to directly impact your annual interest rate. So getting the better your credit score is, the lower your interest rate is. And that's ideal. Anytime you can negotiate to lower your interest rate, that's what you want to do. Because not being in control of your credit score can contribute to higher rates and leads to, as you've seen in our example with buying the home, exponential difference in consumption spending.
The economy, again, you have to keep an eye on what's going on in the world, because what's going on in the world on a macro level definitely trickles down and sends waves down to the micro level. So know what the Federal Reserve is doing, know what the Federal Reserve rate is set at, because that is the benchmark that everything else is based off of. Know what's happening in the world, know what the earnings reports are like, know what the jobs numbers are like, know all of that stuff, because all of that matters, and all of that is going to, it's very difficult to time the market. They always say you can't time the market, and you can't. But you can definitely use that to help you get a better rate by knowing what's going on.
And why rent reporters? If it works for you, then sign up. The best thing about our service is that there's no risk. You have 100% money back guaranteed. If you're not happy with our service, we don't work for you. But if you are a renter and you're interested in seeing how we can help, just do it. That's my best recommendation for you, because we can have a positive impact on your credit score, which not only puts you in a better standing for that interest rate, but it's also going to put you in a better standing to get a loan regardless of the state of the economy. So that's what's really important. And the last thing we're going to talk about is millennials. Are we really doomed? That's a question. I say no. I have a lot of faith in millennials, I know. And I'm glad Carlos is a big fan of millennials. We get a bad rap from sometimes a lot of people, but I don't think that we're really doomed. The great thing is the spirit's there. We're still willing and able to get that loan. The economy's out there. We want it. We just have to make sure that we're making some really smart choices about keeping, getting a good credit score, getting educated, and that's what I want millennials to get from this is instead of being reactionary in your, let's say you're at that average age of 33 to 34 and you want to buy a home, and now you're worried about credit, don't put yourself in that situation. Be more proactive with your credit. Don't be reactionary. So the choice is yours. Make some good decisions, and that's kind of it for today's topic. We have our social platforms. We're on Facebook, obviously, Instagram, and Rent Reporters. The only difference in all of our taglines that you can find us is on Twitter, there is a underscore in between Rent and Reporter. So follow us, ask us questions, and I'm not sure if any questions came in through today, but if not, like I said, most of you millennials are probably out there buying Coachella tickets. Hopefully you got them, but if not, ask us questions throughout and we'll make sure to answer them. Thank you, and we will see you in 2 weeks.